It's time for Charting Futures with Abigail Doolittle. Abigail, what a week it's been for stock and, of course, stock futures. You're looking at a options play in this range.
You're right about that, Joe. But first, let's set the stage and take a look at that week, because it really has been pretty wild. You couldn't have predicted that it would end the way that it is, because take a look at that. Over the last 5 days, for much of the week, we were on pace for a pretty decent-sized decline for the S&P 500 E-mini futures that you're seeing here. Whipsaws around trade pessimism and then, of course, trade hopes. And now, more recently, we have the headline that the U.S. and China are likely to reach a partial deal. So on the week, up 1.3%, the best week for the S&P 500 right now, at least in about a month, and the first up week in 4 weeks. So really, the bulls are out. But interestingly, there's one chart that we've been looking at quite a bit with our options insight guests, and that is this chart right here, the put to call ratio in the S&P 500. Puts, of course, are bearish options on the S&P 500 or whatever market you're playing. Calls are bullish. So when it's the put to call ratio, as it goes higher, that tells you the bears are stronger. That's generally been the case over the last decade, especially back in 2015 ahead of the corrective action that we saw in the beginning of 2016. Last year, going into the beginning of the year, the volatility around Facebook and some of the big tech regulation fears, and then certainly into the fourth quarter. You see, as the fourth quarter played out, that put to call ratio went down, investors taking off those bearish bets as they were coming true. But take a look at this. Right now, the put to call ratio at the highest level over the last 10 years, telling you that there are some bears out there. But again, the options insight experts that we've been talking to recently, they have been saying that this is more hedging, that there are investors out there who are long, but they want protection because of all this uncertainty. To talk more about this, let's bring in Greg Calderon of Bloomberg News. So great to have you here, Greg. And what do you think of that chart? It really stands out that the bears are really outweighing the bulls, at least on, in the options market in that way.
Yes, well, with the S&P right around year-to-date highs, we're up another 160 basis points today ahead of the trade talks. You see that kind of that skew in the put-to-call ratio really starting to trade higher into 4Q. Okay, last year, if people remember, unfortunately, we were down about 14% on S&P between the end of 3Q and the end of the year. So we do see a little bit of a hedging mechanism through that put-to-call ratio going into year end.
Well, a big piece of this, of course, has been the uncertainty, and you have a chart here with you on the E-mini futures, and take a look at this range, and that just really speaks to the degree of information, lack of information, or certainty on the part of the bulls and the bears. So, what do you think is likely here?
So this red line here shows just about the 200-day moving average, which has been generally support. So if we look at this 2850 level, it seems as though the S&P has kind of bumped off that a couple of times. We actually talked about it about a month ago in early September on the same segment. So again, with that move kind of bouncing, call it 3 times off that 200-day just throughout August, and a little bit of a resistance right around the July highs.
Well, so Joe was talking about an options trade, so let's now take a look at your options idea on this, and it's a risk reversal. Talk to us about what that is and why you would put it on here.
Sure. So with this risk reversal, the December E-mini options don't expire until December 20th. So it basically captures the entire 4Q, if you will, of performance. So what we would recommend doing is selling a 2850 downside put, which we think is support for the S&P 500, using that to finance a 3025 upside call, which 3027 is right around the all-time high back in July. JP Morgan was out actually this morning talking about a break above that high level would actually propel the S&P 500 up to 3050 to kind of the 3070 range. So this is really kind of an inexpensive way to get long the market into year end.
Yeah, pay for that long position through selling those puts.